is Indra Abeysekera. One of the learning goals in this workshop is for us to understand how to account for income tax expense and income tax payable. Income tax expense is an accounting number. We first calculate accounting profit based on accounting principles, and then from the accounting profit we determine the income tax expense. Taxable income, which is the counterpart of accounting profit, is determined by the taxation office. It applies the taxation rules and then it determines the income tax payable. One of the key differences between these two is accounting principles are based on events and transactions. They include cash transactions and non-cash transactions, which we call accruals. But the taxation, for our purposes, it is based on cash transactions only. Cash must be received or be paid. So that's one of the key differences in these two principles and rules. Going forward, we make two assumptions. One is that tax will be paid, income tax payable will be paid in the next reporting period, and the income tax rate is 30%. So the company decides its profit based on accounting principles, calculates income tax expense. That is what company thinks it should pay, and it is shown as a debit expense in the income statement. Tax office decides based on taxation rules how much is taxable income, and applying the tax rate you find out income tax payable, and that is what must be paid because it's the law, and it is recorded as a liability, as a payable on the balance sheet. If you put that into perspective in a columnar form, assuming revenue and assessable income, which is the counterpart in the tax office, are equal, and expenses and deductible costs, which is the counterpart in tax office, is also equal, then our profit before tax and taxable income are also equal. Applying the tax rate, then we come up with income tax expense we should pay and income tax payable we must pay as equal 12 and 12. Okay. And then we can record the journal entry. Payable is a credit and expense is a debit. Debit income tax expense and credit income tax payable 12 and 12. Now let's take an asset. It costs $100 and no residual value. Let's say accounting principle says it should depreciate over 2 years, and that is 50 and 50, and the tax rule says it must be depreciated over 4 years, so 25 over each year. But the total depreciation is 100 in both instances. So in accounting, there are more expenses compared to tax. More expenses means less profit, less income tax expense. We should pay less tax. But for the tax office, because of their different rules, there's less expenses, more taxable income and more tax to be paid. Must pay does not equal should pay. There's a difference. So if we put it in columnar form, we can see that assuming revenue and assessable income are equal, 100, income tax expense is 15, income tax payable is 22.5 because we are deducting less cost in tax, more taxable income, more tax to be paid. We are deducting more expenses, less profit, less income tax expense. Must pay is more than should pay. So we can record this transaction first, must pay. Here's that. We record that, assuming that is the correct. 22.5 income tax payable credit and debit, income tax expense 22.5. But we know that we should pay is 15, so we have to decrease income tax expense. For we decrease by crediting, because it's normally a debit account. To decrease, we credit, and then the other side we require is a new account called deferred tax asset. We debit that. So here are the two steps in writing journal entries. First, write the journal entry for the income tax payable, for the must pay. Credit income tax payable, debit income tax expense. Step 2. Do an adjustment entry to report the correct income tax figure. In this instance, there's more income tax expense from step 1, so we decrease income tax expense. 7.5 credit, and then we debit a new account, deferred tax asset debit. So let me show you a total picture here. Accounting and tax. If you depreciate this asset in accounting over 2 years, assuming that assessable income and revenue are equal in all 4 years, 100. The profit income tax expense in year 1 is 15, applying 30% to this profit, 15 in year 2, but in year 3 and year 4 we can see that it is 30, and 30 because 30% of 100. There are no depreciation expense. But in the tax office we can see that there's depreciation, tax deductible depreciation is there over 4 years, and our taxable income is 75 across 4 years, and applying the tax rate, income tax payable is 22.5 over the 4 years. We can notice that looking at each year, that income tax expense does not equal income tax payable. But if we add all the income tax expenses and all the tax payable, they are equal. But across years, they are unequal. These differences arise because accounting applies accounting principle, tax office applies tax rules. And these differences across years, which is temporary, are called temporary differences. So we should pay is the income tax expense. We must pay is the tax payable. Because we must pay, we should pay is less than we must pay. We'll make a saving in the future. We should pay less. Company knows that. But tax office does not know that. They think we must pay more. So company will make saving, tax payment savings in the future. Therefore, that saving will be in the future. It is deferred and it's about tax, and it is recorded as a deferred tax asset. We debit and debit, that's the difference between the two in the first 2 years, and then in the third and the fourth year we should pay is more in the third year than what we must pay. So then this accumulated tax asset gradually gets reversed. We decrease that, and in the fourth year we decrease again. And when we add them together on the deferred tax asset, it becomes zero. That account becomes zero, because the total tax payable and the total income tax expense are equal over all the years in total, and the deferred tax asset that arises from that over all the years become zero. So this is a temporary difference. Here's this in a graphical form. Deferred tax asset builds up and it gets reversed. So what we know so far is, first we record what we must pay based on income tax payable. Second, we record another journal entry to adjust the income tax expense to what we should pay. And the other side of that would be a deferred tax asset. If we should pay less in the future because we are paying more, we must pay more now, and as a result we should pay less in the future. Or it could be other way around as well, that we must pay less but actually we should pay more. If that happens, then we have to increase income tax expense as adjustment, step 2, and then that means we are debiting income tax expense, and then we credit a liability that arises, and that is called, it's because of tax, so it's a tax liability, but it's deferred, so we say deferred tax liability and we credit. So here's an example of deferred tax liability. We must pay, we record that 80 and 80, but we should pay is 100. So we need to now increase the income tax expense to 100. So here's the adjustment, 20. And the other side is what we should pay, the difference we should pay in the future, and that's deferred tax liability credit.